Hey, what's going on, guys, and welcome back to my channel. My name is Alex, and today I want to talk about the importance of defensive stocks, especially in bear markets or in markets that aren't so favorable for investors. I know that there's always a tug and pull between defensive stocks and aggressive growth stocks and dividend paying stocks. So it's always really interesting, especially to me, to think about the perfect blend of all three of those. So today in this video, I want to talk about why it's important to have defensive stocks in the first place, even throughout all market conditions. So this is my M1 Finance portfolio. This is my defensive portfolio. Since May 29th, this portfolio has only gone down about 1.81%, which is actually pretty surprising, considering the rest of my tech stocks and aggressive stocks are getting hammered. And so today I want to walk through a few of these. But for the most part, I think Dividend Aristocrats are a very, very smart way to go. Even if you make that a small portion of your portfolio, in times of a bear market or in times of a recession, you want something that's still going to increase their dividends. And I'm talking about the really boring household names like Procter Gamble, Johnson & Johnson, Pepsi, Costco, Kimberly-Clark, so on and so forth. And it's not just consumer staples, it's other industrial stocks as well. Things like 3M, even though 3M is getting hit really hard. And even a couple of other bonus stocks that I want to talk about at the end of this video. So Dividend Aristocrats are pretty awesome in general, especially if you want stocks that are going to pay around 3 to 4%, especially during times like these. There's a very, very good starting yield on cost. So I basically have maybe three types of stocks in here. So this is all sectors, but the three types of stocks that I'm talking about are my core allocations. So basically, four stocks here make up about 28% of my portfolio. It's either 28 to 30% of my portfolio. So this is definitely the stocks that I care about the most. Then there's the mid-tier stocks, which make up about like another at least 45%. And then there's some stocks that are a little bit more experimental. These are the 3 to 4%ers. And I've definitely moved things around a little bit. For example, this is now 2%. Praxair is now 3%, et cetera, et cetera. So today I'm just going to talk about, in my mind, how I'd like to position myself. So first, let's just give an example of the power of having defensive-minded stocks. So let's first take a look at Costco. So if you take a long-term look at Costco, it's hard to identify a period where Costco was having a bad time. This thing is just constantly in an uptrend, and this bear market situation is no exception. So at the start of 2018, which is basically this period right here, the entire market sold off pretty heavily, and this was the early February, late January sell-off. Since then, Costco has grown a ton in the same way that a lot of these growth stocks have also grown. And here, in times of extreme volatility, Costco is taking a hit, but not as much as you would expect. And if we even zoom out a little bit more, I have a better example. So summer of 2015 all the way up to 2016, the entire stock market experienced a pretty nasty bear market. And it was definitely global stocks included. So this is the summer of 2015 all the way up to the start of 2016. But if you take a look at something like Costco, in the summer of 2015, which was around here, yes, Costco made a low. There was, some kind of volatility here. But the low that we saw here for the rest of the stock market, Costco actually made a higher low. So Costco remained in an uptrend while the rest of the U.S. stock market didn't. One thing to note is that Costco may struggle when the rest of the stock market is doing well, as a lot of defensive stocks might. But for the most part, the uptrend is intact. Let's go ahead and take a look at something like Procter & Gamble as well. So if you look at Procter & Gamble, over the last couple weeks or few weeks, you wouldn't think that the entire stock market is in a sell-off, because Procter & Gamble continues to make higher highs and higher lows. Same thing with most defensive-minded stocks, however. You'll notice that while the rest of the stock market did see a sell-off at the start of 2018, Procter & Gamble continued to sell off and didn't really experience the same type of growth in the middle of 2018 as the rest of the stock market did. So that's one thing to note, is that these defensive stocks might not do as well as the rest of the stock market, especially technology stocks, consumer discretionary stocks, healthcare stocks. I'm talking about the really aggressive growth stocks. You're not going to find that same growth during those same growth periods. And so that's why these stocks are used more as a hedge than anything else. So a hedge doesn't mean that when one stock goes up and you hedge against that stock by having some kind of hedge, that the other stock will go down. And the opposite is also true. If you buy a stock as a hedge, like Costco or something like that, and the rest of the stock market goes down, you shouldn't really expect that Costco is going to go up. But what you should expect is that Costco may not do as poorly as the rest of the stock market. So by having stocks as hedges, which pay maybe 2% dividend yield or 3% dividend yield or 4% dividend yield, something really good like that, you're still going to grow your account and have your money working for you. And when a lot of market volatility comes around, you'll still have your money safely in those hedges. And it's a lot better than cash as a hedge. And if you do it correctly, when the stock market has already sold off a ton, and you have and you have all your money in these defensive-minded stocks, one thing you can do is actually sell those defensive stocks and put them back into the aggressive growth stocks when you feel like there's a bottom. So that's actually something I'm planning on doing, is potentially selling my defensive stocks if the stock market gets a lot worse, because the value lost in my defensive stocks won't be as bad as the growth stocks. So let's go ahead and take a look at the rest of these stocks. So as I mentioned, Procter Gamble is probably my best bet, which is definitely true. 26% plus for Procter Gamble, probably one of my favorite stocks of all time. Pepsi is definitely up there as well with 10% gain. Then Kellogg with the 5% gain, and Costco with also a 5% gain. So those are my core holdings. I want to talk about a few of the medium size holdings. So one of them is Colgate Palmolive. So one of the reasons why I made this such a large holding is because I definitely feel like we're due for a bounce. This could be the start of something really ugly. For example, the 50-week moving average is about to cross below the 200-week moving average, which could be a sign for worse things to come. That's totally a possibility. I just don't see it happening with as many products as Colgate has, and with as many ETFs that Colgate is a part of. Weekly RSI is getting close to oversold. I definitely think if we head maybe to around the $50 range, things could get really ugly. But I'll definitely be watching Colgate pretty closely. Colgate just seemed like a really good buying opportunity. And in my mid-tier holdings, not all of them are necessarily stocks that are really strong, but it's basically stocks that I want my money to be going into. So I do feel like Colgate is in a pretty good buying opportunity. Obviously, I'm down about 18% on it, but the dividend yield is pretty good, and I don't mind having a lot of money in there. Next in the mid-tier holdings list is Constellation Brands, our ticker symbol STZ. So STZ is kind of not really defensive. In fact, it grows extremely, extremely quickly. So it's rare that we even get any kind of sell-off in Constellation. I think Constellation is the best of both worlds. I think it has a lot of parallels to something like Pepsi, but I also think it's almost like the Microsoft of beverages, because it grows so quickly and because of its enticing dividend yield. So like I said, it's rare that we get some kind of sell-offs. The last time we had a sell-off of this kind of magnitude was around the end of 2016. So yeah, I'm going to be all over this. Like I said, the mid-tier holdings are also stocks that I want my money going into, not necessarily the ones that are showing the most strength. So that's Constellation Brands. The last stock I want to talk about in my mid-tier holdings is Clorox. So Clorox I'm doing very, very well on. It's about 18% up in profit. And Clorox is another one. It's pretty similar to Procter & Gamble in that it's showing a ton of strength. And it just made a 52-week high, I want to say a few days ago. So that's really, really good, because when I see something like that, when I see a stock making 52-week highs, especially something that's in consumer staples like Clorox, it makes me feel like this is a safe haven for investors. Still in an uptrend, still above both the 50 and the 200-week moving average. So I have a really good feeling about Clorox. And I want to talk about a few of my kind of smaller stocks, or at least smaller allocation stocks. So I want to talk about Caterpillar, 3M, and Home Depot. So Caterpillar, I'm down quite a bit on, which is 31%. The reason why I want to talk about this is because I feel like a lot of people may be invested in Caterpillar, and I just want to say that I don't think it's reason to completely, just give up right now. RSI is getting close to oversold on the weekly, and we still have the 200-week moving average support. Still in an uptrend, in my honest opinion, and this just looks extremely, extremely attractive to me, especially for something like Caterpillar, which I don't see going away anytime soon. If we take a look at the proportion of these retracements, so this is about a 25% retracement, and then if this is a 3-wave move, so it's about a 28% to a 25% retracement. So we've already gone down more in this run than this run right here. So this would definitely be an ideal place to bounce. So Caterpillar I'm liking. The other stock which got hit pretty hard is 3M. And I have no problem whatsoever with putting more money into 3M. 3M is still in a long-term uptrend, both moving averages sloping upwards, just like Clorox. And 3M is actually showing support here at the 200-week moving average. I really, really like this one. I may even bump this one up to a medium-sized holding, or at least maybe 4% or something like that. Actually, I want to skip Home Depot. I just want to say I added a few more stocks, which are Roper Technologies, AOS, and AbbVie, just very quickly here. I want to take a look at Roper, which I just added. So Roper is showing a ton of strength. This is one of those Procter Gamble / Clorox ones, which I like. I'm going to invest in it for maybe a few months and see what happens. AOS is one of those that's in a really good buying opportunity right now. So weekly RSI is absolutely destroyed. It's at 18 right now. But both moving averages are still in an uptrend. So I kind of want to take a gamble on this one and just see where it goes. And the last stock I want to talk about is AbbVie. So AbbVie, which is also pretty similar to Abbott Laboratories, is also, I think they've increased their dividend yield for around 20 years or something like that. Both moving averages sloping upwards. AbbVie, I have no problem with investing. I think it's in a pretty good buying opportunity right now. So anyway, I hope I didn't over talk and make you guys bored. But as I said, the importance of something like a defensive portfolio is to basically have your money consistently working for you, and even times of very high market volatility, your money is going to be in somewhat of a safe place. It doesn't mean that it's not going to go down at all, but it's going to go down probably less than your aggressive portfolio. And if that's not the case, then you may have to do some tweaking. When I feel like the market has bottomed, I may move some money out from my hedges and put them back into aggressive stocks. And that's always an option that's really nice to have. I may or may not do it. And again, the dividends are pretty nice. So we'll definitely see what happens. I'm excited to put more money into those stocks and get more shares and get more dividends and just keep it going and going and going. So before this video gets too long, I just want to say thank you guys for all the support recently, all the likes and all the comments. You guys are awesome. And I hope you have a great day and good luck trading.